Good afternoon and welcome to another Tax Tuesday. Today we're going to be talking about something we see every single year, business owners and investors making good financial decisions, but accidentally poor tax decisions. Tax law is not just about filing a return, it's about how your behavior throughout the year shows up on that return. Sometimes the issue isn't that you did something illegal, it's that you didn't document it, you didn't structure it properly, or you didn't understand how the IRS views it. So our goal today isn't to turn you into a tax expert. It is to help you think like an owner or an investor, not just a tax filer. I am Clark Boyd, and together is my co-host, Kathy Stump. We are with Molen Associates. At Molen, we believe in proactive planning. We believe that proactive planning prevents the reactive problems. And we've been helping taxpayers unravel tax headaches since 1980. So by the end of today, we'll keep it nice, short, and sweet. You should know the difference between an IRS letter and a true audit. You should know what could trigger an IRS attention. You'll know the most common red flags that we commonly see with most of our tax filers, but also what proper documentation can help protect you in that situation. So think of this as your IRS risk awareness playbook: awareness, prevention, and protection. So we're going to jump right in with IRS letter versus an audit.
I think this is a really common misconception. Some people take two extremes in looking at IRS letters. They either think it's no big deal and they don't pay much attention, or they get completely upset and overreactive to the issue. A lot of times it is just an informational type filing. It's not an audit if you just get an IRS letter. They're usually pointing out things that could possibly be problems, but that you could address usually fairly easily. Income mismatches, maybe you forgot a 1099, or you worked for an employer for a very short period of time and only had, like one paycheck and you forgot about it and didn't include it on your return. The other thing is just math errors. Even though most people could prepare taxes nowadays with computer software, it's still only as good as the numbers that you put in, and you can make a math error at any point in that process. It's also your identity. You are identified in the Internal Revenue System by your Social Security number, and if there's a transpo in that, or in the event that you've gotten married and haven't changed your name, or you legally changed your name but didn't change it on the Social Security Administration, is where they get that. The other thing is a big problem that generates a lot of IRS letters is 1095A reconciliations. And this is if you have marketplace health insurance. And they report that every year, and it is reported to the IRS, and it's a very common mismatch that people either forget they have it, they lost their letter, they didn't think it was a big deal, they neglected to tell the preparer that they had received a 1095A. And in some cases, they are just mistakes. Like we've seen some where people go in and think they're just going in and checking rates and seeing what it would look like, and didn't realize that they created an account, and they'll still get a 1095A for it and not realize that they even had one. The other common one is underreported 1099s, especially for businesses, usually Schedule Cs, that receive a lot of 1099s. It's very easy to miss one. Or, it could have got lost in the mail, whatever happened that you didn't have it. But if it's filed appropriately with the IRS will have it, and they'll know if you don't report it on your tax return. So it's always important to make sure you try to remember those and make sure that you've accumulated all of them. The other common thing is escalations from mismatches, unresolved letters. If you've got a letter and you've just either, sometimes it does happen that you just don't get it. But they send more than one. So just make sure that you're always, if you get something from the IRS, don't, get too overly concerned, but at least open it and see what it is. If it's something that can be really resolved really quickly, just a quick letter and say, this is the reason I did this way, here's my proof of it, and it could be done. But if you ignore it, the IRS is not going to go away. They're going to, escalate their kind of reach outs to you, that they're going to make those a little bit more serious every time they send you a letter, to the point that it becomes a more serious problem.
I'll add right here. So most of these are computer generated notices. For the most part, no one has looked at your return. It's really just processed through the algorithm. They're not personal, they're not emotional, they're really just math. And more than 50% of the time when we open up an IRS letter, it's wrong. It's done in error. So really it's just a simple response to the IRS saying, hey, nope, here's my proof. Here you go, we're done. So don't freak out. Please open the letter. I can't tell you the number of times we had clients coming here with a stack of letters saying, hey, I've been getting these letters for 6 months and I'm too scared to open them. And it's a CP 2000 for really a non-issue. And it's compounded to the point where now they've got a levy on their house when they could have prevented it 6 months early. It wouldn't happen that fast, but you get the picture. The IRS is not something you just want to delay and delay and delay. It's better to deal with it proactively and promptly. Sorry about that. This next section here, I want to go over some common red flags. So the home office deduction, I'll go through each one of these almost kind of rapid fire, just to give you an example of what we see, what some of the issues are. So starting with home office, this is probably one of the most misunderstood deductions. And I think a lot of it comes from pre-2017, before the Tax Cuts and Jobs Act. We had a lot of employees taking this. So one of the big issues still to this day, we're now almost 10 years later, we still have W-2 employees trying to claim the home office deduction. A lot of business owners, real estate investors think, oh, I've got a business, I can now claim my home office. It's not that simple. There's different ways of doing it depending on the type of filing you have. If you're claiming your home office, but you're also deducting rent elsewhere, that can also cause some issues. Maybe you're not meeting the exclusive and regular tests. So if it's used, maybe you're using your bedroom. Okay, it's not exclusive for office purposes. Or maybe you have unrealistic square footage. If your house is 2,000 or 3,000 square feet, and you want to say 1,500 square feet of that is home office, it's probably not going to fly. So the biggest thing here is you want to have documentation. Another thing for S-Corp owners, make sure you have an accountable plan. That's one thing that we really, really push our S-Corp owners to set up. Not that it really makes a huge difference as far as your numbers go, but it just, if you are in the instance where you are audited, having an accountable plan, having it documented, having those funds that you can track easily, it makes it so much cleaner, so much easier to defend rather than, I didn't know. We're telling you right now, you can know, it's not that hard, you can do it. So once again, the space must be used exclusively and regularly for business. If you want to use some documentation, use the floor plan. You can do a square footage calculation, take photos of it. If you're trying to do utilities, do the actual expense method, you can use a utility allocation worksheet. But the bottom line here is home office deduction is legal, guessing is not. So just make sure you're documenting it, you're doing it correctly the first time. If you have any questions on if you apply, how it applies, work with a tax professional. That is why we're here, to make sure you understand not only that you qualify for it, but also how to document it and how to do it the correct way. The devil really is in the details. The second one here, wrong filing status. This is really big. With our existing clients, this is not a huge one, but a lot of new clients coming to us, we say they're filing the wrong household status. And it's not necessarily that they're trying to do it illegally. They just believe that you can pick your filing status. And in most cases, you can't pick. You qualify for a status. So we see head of household being used, or maybe they're filing single instead of married filing joint, or even married filing separate when they're legally married. Sometimes there's married filing separate. When we review the returns, there's some mismatch errors there. Maybe you're separate but not legally divorced, or you're living together but you're claiming head of household. So there's a lot of nuances here. But at the end of the day, there's only so much that you can choose when it comes to your filing status. It just is. So this is not about tax planning. This is how you are. There's some amount when it comes to like married filing joint or married filing separate. There can be some strategies there in certain circumstances. But for the most part, just talk to a tax preparer, make sure you understand why you are that filing status. And your filing status is determined on December 31st of that tax year. So in tax season 2026, the filing season we're in right now, your filing status was determined on December 31st, 2025. So if you're divorced now, but you're married on January 1st, your 2025 tax return, you're either married filing joint or married filing separate. Those are your two options. So just pay attention to those, because those can get tricky fast. Head of household gets you some pretty good tax treatment. So the IRS really pays attention to that one. So don't abuse it. That is not a chance you want to risk. Number 3 here, meals and entertainment. This is one that post-COVID, we got that bump up for some meal deductions at 100%. We still see some business owners trying to keep that going. You also can't write off family dinners. The biggest thing I'll mention here is keep your receipts, and on those receipts, write the who, what, where, and the business purpose. So receipts fade, but if you write those down on the receipt, take a picture of it, add it to your Dropbox, Google Drive, whatever you do, save a digital copy, because receipts fade over time, especially in the Houston heat. Those numbers are not going to be there in 2 years if you ever happen to be audited. So keep the documentation of business purposes. Another one I'll mention here is if the quantity or the amount you're spending on meals is excessive in comparison to revenue, that can also be a red flag. One other note, meals and entertainment are 2 different categories. So meals are a 50% deduction. Entertainment is no longer a tax deductible business expense. Also, don't use round numbers. Round numbers are usually not a good thing because it means you didn't really spend that amount. That means you're guessing. And kind of like what I said earlier, home office deduction is legal, guessing is not. That really applies for all of these. You want to know your numbers. So what that means, starting with good, clean books and making sure you're doing things properly or keeping your receipts, all of it adds up. Okay, the next one here, I will go vehicle deductions. Actually, you know what? I'm going to add in one more just for the sake of having fun. Schedule C. So we see a lot of Schedule C red flags. We work with a lot of small business owners, whether it's an S-Corp or Schedule C, but having multiple years of losses is probably one of the biggest ones, because I meet with all of our new business clients coming on, and a lot of times they're at a loss for 2, 3, 4 years in a row. The IRS does not like losses. So if you're taking these losses, eventually you will be at risk of having a hobby loss. And usually that's around 3 years. So pay attention if you're taking large expenses and you're offsetting some of that W-2 income through your Schedule C losses, you better watch out. It's not a matter of if, it's more when. If you can prove an intent to drive profit and you have your deductions all squared away, you should be okay. But for the most part, you really should be turning a profit by year 3 or 4. Couple other Schedule C red flags I'd say watch out for. If you have large other expenses or miscellaneous, please just don't use other or miscellaneous. It's not needed. You can always define it better than that. It's laziness. That's all it is. Another one, high auto expense versus your income, or no payroll versus your income. So the payroll wouldn't apply if you're Schedule C, but as an S-Corp it would. And once again, round numbers, not having substantiation. So those are all kind of a mini bullet point in there with self-employed Schedule C filers. But going on to number 4 here with vehicle deductions, some common red flags here we see are not having a mileage log. So it sounds very, very simple, but it is kind of tedious. So if you have Hurdler or Mile IQ or even QuickBooks, Intuit has a program where you can track a mileage log. It's better to have it and not need it rather than need it and not have it. So start it now if you don't have one already. If you're doing 100% business use of your vehicle, you really need to have documentation of it, because that's fairly uncommon when it comes to small business, unless you have a fleet of some sort and they really are truly dedicated for your business. Another red flag we see is switching between the standard mileage rate and actual vehicle expenses. So there are rules around that. You can't just flip-flop back and forth based on which one is better for you. I believe you can change one time and you got to stick with it. So you should not be flip-flopping. It should not be, hey, which one's better for me this year? That will be a huge red flag. Bonus depreciation is pretty big right now with the one big beautiful bill. We don't want to be a lot of today's red flags. So it's more, how can you document? How can you avoid the IRS? There is a time and a place for tax planning and being more creative. But with the creativity comes, you need to have the documentation properly set up to do so. So documentation is everything. I think that's number 5, real estate investors. Couple things here, cost segregation and real estate professional status. We see these, a lot of people want to do bonus depreciation and they just decide, oh, I'm going to do it without a cost segregation study. So you need a cost segregation study. It needs to be done properly. Real estate professional status, that is probably the most I don't know about the entire tax code, but it's probably pretty high up there. The benefits are just so great that people think, oh yeah, that's close enough, I can do it. But real estate professional status is actually pretty difficult for most taxpayers to achieve, because most of the time you've got a couple rental properties and you have a full-time day job. It's going to be very, very hard to qualify at that point. So also with short-term rental, there's a lot of tax benefits there. If they don't have a good understanding of how to do the short-term rental loopholes, that can go south pretty quickly. Really, with real estate investors, I recommend you listen to one of our previous webinars specifically on real estate investing, because there's differences between active and passive, or passive and non-passive errors, what you do with large bonus depreciation, offsets, paper losses versus W-2 income. So there's a lot of moving pieces when it comes to real estate, and most people just don't understand accounting enough to know that they're making errors. They just do it kind of ignorantly, and ignorance is not bliss when it comes to the IRS. So you can't just claim ignorance. With the government, you're innocent until proven guilty, but with the IRS, you're guilty until you can prove otherwise. So keep your documentation, do your due diligence, make sure you understand what needs to happen. S-Corps. So I touched a little bit on S-Corps with the accountable plan, but a couple other ones to note here. Reasonable compensation. It was 2-3 years ago, we went to a few conferences, and this was one of the top 2 or 3 things that the IRS was hitting on, was not having reasonable compensation. So if you have an S-Corp doing $200,000 of profit, you're paying yourself distributions, and you're not paying yourself reasonable compensation, you're really looking for an audit at that point. Not to say you have to pay $175,000 in W-2, but there is a reasonable compensation, and we can help you with that analysis to make sure you're not overpaying in your FICA, but you're also staying compliant with the IRS guidelines by being an S-Corp. An S-Corp is a valid strategy. It's a tax election. It's an operational structure, but you have to do it compliantly. So taking large distributions versus low salary can be a red flag if you do it incorrectly without documentation. If you have no payroll process, that's definitely going to be a red flag. Shareholder loans is another good one. So we see this oftentimes, sometimes done out of ignorance when it comes to the taxpayer. They don't know that their accountant is putting a shareholder loan on there because of the way they've done distributions. And sometimes they've done it to be creative, but sometimes creativity is not always a good thing. Sometimes it is just straight illegal. So if you are doing shareholder loans, make sure you do it with proper documentation. Proper expenses within an S-Corp. Personal expenses within an S-Corp. There are certain personal expenses, your cell phone, your internet, your vehicle, things like that. It's allowed through an accountable plan. Another one, and this didn't used to be such an issue, is late S-Corp elections. So I'd say up until 2-3 years ago, you could elect an S-Corp just about any time, and the IRS is going to approve you, no problem. But it seems like they're really cracking down on S-Corp elections being filed timely, as well as the reasonable compensation. So just make sure you do it timely. Make sure you talk to someone that knows what that process looks like so they can do it correctly. And last one here, and then I'll turn it back over to Kathy for more on documentation. High income earners. So this one, I say a couple points here. Crypto activity, if you're not reporting your crypto, and that's sometimes hard to come upon. If you're using Coinbase or some of the bigger platforms, they'll give you a good report that you can use. But if you're doing different platforms, it can get fairly tricky. So make sure you record all of your activity. If you're doing non-cash donations above a certain threshold, I can't remember the threshold off the top of my head. I believe it's pretty low. Kathy, do you know that threshold for non-cash?
$5,000. It's over $5,000.
So if you're doing more than $5,000 in non-cash donations, you need an appraisal. And I was reading an article about this actually just a day or two ago. It's such an easy thing, so just don't miss it. Another red flag can be large charitable contributions relative to your income. So that's all I got for common red flags. Also, one quick note before I pass it on to Kathy. If you guys have questions, in the bottom toolbar, there will be a chat bubble with a question mark in it. Feel free to click that, and you can add questions to our Q&A. We'd be happy to answer those at the end. Or if they apply as we're going through, we can take a minute and answer those as well.
All right, going into documentation. And really documentation is one of the most important things that you can do as far as, protecting yourself But also, it goes beyond just the IRS. You really need to know what your business is, how it's operating, what the real net profit is. Are you working towards something? Are you really just having a hobby? All of those things can be proven by your documentation. And a lot of people think that they can just, I'm getting audited, I'm going to go back and gather up 3 years of documentation. And trust me, you're not going to remember things are going to be lost. Things are not going to make sense to you. Like Clark said, sometimes your receipts that you carefully kept have now faded due to time. Documentation is basically is really your armor against the IRS claiming because they really don't have to prove anything. They just have to ask you, will you put this number on your tax return? Where's your proof? And if you don't have any proof, they can take it completely off. They can increase it, decrease it. They can pretty much do whatever they want if you don't have the correct documentation. Going back to like accountable plans, that is relative to business owners. Just think of it like you were working not for yourself, but for another company, and you ran to the office supply store and picked up, paper and ink and whatever. And you came back and you have a receipt in your hand and you give it to whoever is in charge of that at your company and you get a reimbursement check. It's really just that simple. And that way it's a proven expense for the company. They've got your receipt, they've got your documentation, and then it's not income to you. You have that reimbursement because you paid the money with your own money and then they reimburse you. So it's really simple. Payroll compliance is another big one. Clark has touched on a couple different times, but they are really looking at that because S corporations do have some really good tax benefits. Kind of not avoidance, but partially free, never free of income tax, but always sometimes free of payroll taxes. And they're not going to give you all these great benefits and then not hold up your side and at least do some contribution into FICA. Those kind of things, separate accounts and clean books, can't be stressed enough, especially on a corporation. I mean, you're actually running a business. It's not just a side gig. It's a real business. It has its own tax return, its own compliance issues, its own responsibility to report correctly to the IRS. So just make sure that you're keeping good records, that you have separate accounts, that you're not commingling, especially in your personal account. Don't be using your personal account as your business account. Like an ounce of prevention is worth a pound of cure. Going back and trying to compile all this, if you are audited, could be a nightmare. And it could cost you a lot too, because there's probably not any situation that you're going to be able to go back and prove, 3 years ago exactly what happened. Making sure that you're keeping that plan before you file. It makes a lot of sense when you go to whomever's doing your taxes for you to have all that stuff ready, have your expenses summarized, have your receipts to prove if needed. And it also gives you a good understanding before you it's not like you just walk into the office and pick up a tax return and you don't understand anything that's on it because you didn't really provide any of the documentation. It was just a P&L or however your tax return got prepared. It's really important that you understand as well, and so that you can ask intelligent questions and sometimes bring up discrepancies. It's like, oh well, my inventory doesn't look right, or this doesn't look right, and most tax preparers are happy to go through that with you and explain, and sometimes there are errors. So your kind of involvement in your business is really, really important.
Well, Jill mentioned here, as a business owner, you really should be the captain of your ship. If you don't care about your financials, if you don't understand them, if you don't know where you're going and what the numbers mean, you're not doing your due diligence as a business owner. So you are setting yourself up to fail. Your tax advisor, your accountant, your bookkeeper, all of these people are advisors to you. They are not the captain. You are the one making decisions. So we can hear at Molen Associates, we always say we educate, not just calculate. So we can educate you and we can do the calculations. We can help you. But at the end of the day, we can't care more than you do. If you give us bad financials, there's only so much we can do. If we're doing the books and we're having to chase you down to hunt for statements, there's only so much planning we can do when it's December 31st. So be proactive. It's always better to be proactive rather than reactive and cleaning up all the time. Sorry for my soapbox.
No, it's a good one. And the other thing too is if you have that, you get toward the end of the year and it's a hard cutoff. You're cut off at 12/31 of making any kind of planning decisions. Basically, what's happened on 12/31 is what you're going to have to live with. And if you have good records throughout the year, you can analyze trends. It's like, oh, well, this expense is higher than it should be. What's going on? Checking into it and making corrective action is one of the best uses of your records. The tax return is required. You have to do the tax return, but having your records to the point that you can go in and spot trends in your business, look forward to, oh gosh, revenue's going up. What do I need to do? Do I need to pay more estimated payments so that you don't get a big tax surprise at the end of the year? There's quite a lot of uses for your records throughout the year. So it's not something that you really should just throw together at the end of the year to do your tax return. It's something that you should already have in place and that you should be using for your business.
Thank you. So now we've covered a lot of ground. We try to keep these to plus or minus 30 minutes. So we're going to open up now for some questions. We've got some in the chat I will start with. So number one, if I haven't received an IRS letter, does that mean I'm okay?
Not always. IRS has a wide window of opportunity to send out letters. And sometimes they get it right up to the end. So just because you haven't received one doesn't mean that you won't. And if you have something that you are kind of worried about or thinking about, there's a good chance that something's there. There's some reason that you're worried about that or thinking about it. Keep an eye out for those letters. When they come, like we said, don't just put them in an envelope. Don't throw them away. Make sure that you are responding to them. If it's something that you don't understand, consult a professional because you don't want to respond incorrectly. If you don't answer the question that they ask you, then they can come back and say, well, that wasn't a valid answer, XYZ, and just make you have, just live with their result. When you might have valid documentation of why it's not correct or why the information you're providing is a better solution to the problem. That letter, when it comes, is very time sensitive, and especially with the mail situation right now, it can be like you get it one day and the response is due the next day. And the IRS can sometimes be lenient on that. If you say, I just got this letter, here's my response, fairly quickly. But they don't have to be. They're requiring you to send in that documentation by that date. So always make sure you look at the dates.
Perfect. If I get a CP 2000 notice, does that mean I'm being audited?
Not necessarily. A CP 2000 is just an income mismatch. Like we talked about earlier, you could have missed a 1099 on your Schedule C. You could have forgotten about a W-2. There could have been a transposition error in entering your numbers in the tax return. That's another reason to always kind of check your tax return. Obviously, accounting professionals try to be diligent and make sure that their numbers are reported correctly. But ultimately, it's your tax return, so always look at those things. It doesn't necessarily mean it's that you're going to be audited. It's just an information request. So just take it as that and make sure that you get your response out in time.
Thank you. Okay, this one, I'm not sure on the context here, but the question is, if we are charging client for, if we're charging the client for mileage to do pickups and drop-offs, do we have to be exact in tracking, do we have to be exact in mileage and tracking? Is the mileage tracker sufficient?
If I'm understanding correctly, you are charging your customer to just based on a mileage, like for instance, a delivery where you're 20 miles from me, I'm charging, $4 an hour or $4 a mile, whatever you're charging. It doesn't necessarily have to be your real expenses. I mean, your mileage rate with the IRS is 70 cents this year. It can be more than that. It is important to document it. The mileage, some kind of a mileage log is key to that, though, to be able to take that to be able to prove that deduction. And you also want to have it for your customer too. If your customer questions you, it's like, well, you charged me an extra $40. What's that for? And you want to be able to say it's because I drove 10 miles to your business. And, they'll be quick to know that if it's only 5 miles. So it is important to have a record of that. And please let us know if that's not the question you were asking, and we can respond back in an email.
What happens if my ex-spouse has already claimed our child on their taxes?
That is a situation that happens quite often, to be quite honest. If that happens, you need to file your return correctly, claiming the child if you are qualified to claim the child. But unfortunately, you do have to file that return on paper. And basically, at that point, it's just up to the IRS to kind of duke it out. They may ask you for other proof that that you met the qualifications. The child lived with you more than half the year. You provided more than half the support. You're entitled to the deduction. They could ask the same thing of your spouse. And basically at that point, it doesn't really have anything to do with your divorce decree or anything like that. It's what actually happened. Like, where did the child live and who paid the expenses?
Let's say we got 2 more questions here. If my business loses money for several years, will that automatically trigger an audit?
It won't automatically trigger an audit, but it could trigger an audit. That's one of the things that IRS looks at in their algorithms, and just kind of a common sense type thing. If you're running a business and you have several years of losses, they want to know why you're doing that. Is your business just not successful? Have you not got it off the ground yet? Or are you trying to offset your W-2 wages or other high weight income with a hobby? And they look at that. A business has to have a business purpose and an income generating objective. And it doesn't necessarily mean that sometimes you miss those and that you cannot have a loss. But if you do that for year after year after year, it could very well trigger an audit.
Awesome. And not awesome on that, but thank you for your answer. Last question for today. Is it better to amend a return if I realized I made a mistake?
In general, yes. Sometimes if it's a small amount, you might just wait for the IRS to send you a letter. It's like, oh, I missed $10 worth of interest. The IRS might send me a letter for that. And if you feel like it's less hassle to just wait for the letter and send them a check or pay online when you get that letter. If it's something big or something that's going to require documentation or anything like that, I would be proactive and go ahead and amend the return before the IRS starts questioning it. Because it's much easier to do an amendment, even as much of a pain as those can sometimes be. It's still much better than getting audited and have to prove every single item on the return.
Perfect. Thank you. Well, thank you everyone for joining in for this week's Tax Tuesday. We help you got some clarity around what can trigger an IRS, basically trigger their attention, how to plan ahead and significantly reduce your risk. Our goal isn't to avoid the IRS. You have to work with them in some form or fashion, but our goal is to be defensible. So if you have any specific questions moving forward, you've got our email and phone number up here. We're happy to help you. We'd rather help prevent problems rather than fix them on the back end. So be sure to join our next Tax Tuesday. Next week, we'll actually be having an in-person event. So on March 10th, we will not have a webinar. We're doing a special kind of business coaching session. It'll be in person at our lunch. We'll be bringing in lunch. So feel free to join us, and then we'll continue the weekly webinars after that. But thank you guys for joining us. Have a great day.
Thanks. Have a nice day.